Hello friends, welcome to Business Hologram YouTube channel. Today we are reviewing the company IndiaMart Intermesh Ltd. First, let's get into the company overview part. IndiaMart is India's largest B2B online marketplace, holding approximately 60% market share of the online B2B classified space. Founded in 1996 by Dinesh Agarwal and Brijesh Agarwal, it serves as a critical bridge for MSMEs to discover products and connect with suppliers. If we look at the core metrics of the company, we can see that the market capitalization stands at 12,408 crores, which falls into the mid cap segment. The current stock price is 2,065 rupees per share, and if we look at the 52-week range, we can see that the lowest price reached was 1,925, and the highest price touched was 2,799. It went for IPO on July 4, 2019. Next, if we look at the core business and ecosystem of the company, we can see that the company operates a two-sided network that leverages massive digital scale to facilitate business interactions. Its registered buyers as of FY25 is 211 million users, and the suppliers storefronts include 8.4 million. Live product listings include 119 million across 98,000 plus categories. If you look at the business model, we can see that the buyers has a free access to discover products and services. Sellers model includes a freemium model, which is while basic listings are free, revenue is primarily driven by subscription fees paid by suppliers for premium visibility, lead generation, and advanced tools. If you look at the monetization metrics, we can see that the paying subscription suppliers include 2,17,000 users. If you look at the annualized average revenue per user, it is rupees 61,000. Now let's see the financial performance of the company for the last 4 quarters. We have taken the parameters like revenue from operations, EBITDA margin, and net profit. You can see the values in the screen. The key highlights that we get from the key insights that we get from the data include regarding the profitability headwinds. That is in Q4 FY26, consolidated net profit fell 72% year on year. This was primarily due to market losses on the company's treasury portfolio, driven by a sharp rise in bond yields. Next is revenue growth. Revenue from operations grew by 13% for the full year, reaching rupees 1,569 crores. This growth is largely attributed to a focus on increasing average revenue per user, which rose 8% to 67,000 rupees per user. Next key insight that we get is cash position and dividends. Despite the quarterly profit dip, the company remains cash rich with a treasury balance of 3,280 crores. Reflecting this strength, the board recommended a total dividend of rupees 60 per share. Next is operational scale. The platform registered 27 million unique business inquiries in Q4 alone. The supplier storefronts growing 5% to 8.7 million. Now let's look at some of the strategic initiatives of the company. In 2026, IndiaMart strategy has evolved from being a simple B2B discovery platform to becoming a comprehensive enquiry to invoice ecosystem. The company is leveraging its massive cash reserves to pivot into SaaS and fintech, ensuring it remains the primary operating system for Indian MSMEs. We'll be discussing 4 strategic initiatives of the company. Let's get into the first point, that is a transition to SaaS-led ecosystem. IndiaMart is moving beyond lead generation to provide the actual software tools businesses use to operate daily, which include full stack commerce. The vision is to handle the entire business life cycle: discovery, negotiation, payments, accounting, and logistics. Also, they are focusing on accounting dominance through its 100% acquisition of BSE Infotech and strategic stakes in Vyapar. IndiaMart now controls a significant portion of the SME accounting software market in India. Next, they are focusing on workflow integration as well. Recent investments in AirChain, which is a procurement software, and Fleets, which is logistics and fleet management software, show a clear focus on automating the supply chain for its members. The second point, or the second strategic initiative of the company, is AI and data intelligence. The company is aggressively integrating generative AI to solve the unique challenges of the Indian market. First, they are considering voice AI and conversational commerce to bridge the digital divide for less tech savvy users. They are deploying voice AI to assist in negotiations and follow ups. Next, they are also focusing on algorithmic matchmaking. That is, we are utilizing AI to handle English queries and common misspellings to improve lead quality. Next, they are also focusing on automated cataloging using AI tools to automatically enhance product images and descriptions, reducing the friction for small sellers to go online. The third strategic initiative they are undertaking is fintech and credit access. IndiaMart is positioning itself as a facilitator of business finance. They are following the OCEN integration by leveraging the Open Credit Enrollment Network. That is the OCEN. The platform aims to help its 221,000 plus paying subscribers access credit more easily based on their transaction history on the platform. Next, they are also focusing on secure payments, scaling Pay with IndiaMart to ensure secure B2B transactions, which increases trust and platform stickiness. Next strategic initiatives undertaken by the company is market expansion and retention. First, they are focusing on tier 2 and 3 markets. With 67% of MSMEs now digitally ready, growth is being driven by smaller urban centers rather than just major metros. So they are very much focusing on the tier 2 and tier 3 markets. Next their focus point is yield over volume. The recent strategic shift focuses on increasing average revenue per user, that is the RPU, by selling higher value subscription tiers and cross selling SaaS products rather than just chasing new user signups. Now let's look at the ownership structure of the company. As you can see in the screen, the promoters hold 49% of the shares, led by founders Dinesh Agarwal and Brijesh Agarwal. Holding has remained stable over the last year. Uh, Foreign institutional investors hold 19.17%, includes major global venture capital and investment funds. Domestic institutions or the domestic institutional investors hold 13.54%, primarily mutual funds and insurance companies. Next, the public, that is the retail and other investors, hold 18.18%. Definitely, which includes individual real retail investors and high net worth individuals. So we can clearly see that the promoter group led by the Agarwal family has maintained a consistent stake near the 50% mark since the IPO, which is generally viewed as a sign of management confidence. Also, if you talk when talking about the institutional confidence, combined institutional holding, that is FII plus DII, stands at approximately 32.71 percentage, while FII holding saw a marginal increase in the March 2026 quarter. DII holding saw a slight consolidation from the previous quarter. Uh, Next, we can also see the mutual fund presence in the ownership structure. Domestic mutual funds are significant stakeholders with presence from major houses such as UTI Mutual Fund, Nippon India, and ICICI Prudential, reflecting the stock's inclusion in several mid-cap and technology-focused schemes. Next key insight we get is zero pledge. As of the latest filings, 0% of the promoters' shares are pledged, indicating a healthy financial position for the controlling group. Next, let's get into the financial ratio analysis part. First, we will begin with the profitability ratios. So, IndiaMart is an industry leader in terms of profitability. While many e-commerce companies struggle with uh, the burn factor. IndiaMart is a cash generating machine. Its biggest challenge in 2026 is not operational efficiency, but rather the effective deployment of its cash pile to maintain these high growth ratios. So in the screen, you can see the various profitability ratios of the company. First is operating margin. The company's value stands at 31.97, where the industry average is 17. So it is clearly outperforming in this aspect. Next, if you look at the net profit margin, the company's value stands at 30.27, where the industry average is 12.5. In this aspect also, the company is outperforming when compared with the industry peers. Next, if we look at the return on equity part, we can see that the company's value is 25.86, where the industry average is 14.1. In this aspect also, the company is outperforming. Next, if we look at the return on capital employed factor, we can see that the company's value stands at 36.38, where the industry average is 18. Here also, the company is maintaining a much superior position compared to its industry peers. Next, let's look at the leverage ratios of the company. As a summary, we can see that the IndiaMart's leverage status is superior. It is one of the most financially stable companies in the Indian internet ecosystem. The lack of debt compared with a massive cash pile provides it with the moat that is very difficult for smaller venture capital funded startups to cross. So we can see the two major leverage ratios that we have taken. First is debt to equity. IndiaMart's value stands at 0.02, where the industry average is 0.45. So it's performing exceptional in this case. And if we look at the interest coverage ratio, the company's value stands at 68.5, where the industry average is just 8.2. So in this aspect, in the interest coverage aspect also, the companies, we can clearly say that it is in the ultra safe uh, mode. Now let's look at the valuation ratios of the company. As a summary, we can see that the IndiaMart is currently in a value growth zone. While it isn't cheap in absolute terms, it is trading at a significant discount to its own historical 5-year average PE, which was often above 45. For a company with 30 percentage plus margins and 36 percentage ROC, a PE in the mid 20 represents a relatively stable entry point compared to the broader tech sector. So the values like PE ratio, price to book value, price to earnings, and price to sales are given in the screen. So let's analyze the values. First, if we look at the price to earnings ratio, the company's value stands at 25.21, where the industry average is 38. So it's quite attractive. The company's PE ratio is attractive or fair in this value range. Next, if we look at the price to book value ratio, the company's value stands at 5.24, where the industry average is 7.1. It's also a reasonable value. Next, if we look at the price to sales value, the company's value stands at 7.91, where the industry average is 9.5. So it's also fair on the standard range. So we can clearly see that the company's value is well below the industry average. That is generally a positive sign of the company. It is not overvalued, and it is its value is in the growth segment only. Now let's do a SWOT analysis of the company. First, we look into the strengths of the company. So first point that we are considering under strengths is dominant market position. The company holds a 60% market share in the online B2B classified space in India, creating a massive competitive moat. The next point is powerful network effect. With over 211 million buyers and 8.4 million suppliers, the platform becomes more valuable to all users as it grows, making it difficult for new entrants to compete. Next point is negative working capital model. Collect subscription fees upfront, providing a robust and consistent cash flow. Next is a strong financial profile. A virtually debt-free balance sheet with a massive cash reserve of over 3,200 crore with high ROCE. Next point is diverse product categories. Covers over 98,000 categories, ensuring the business is not overly dependent on any single industry or sector. Next, let's look at some of the weaknesses of the company. First point is subscription concentration. Revenue is heavily dependent on a small percentage of paying suppliers. Next is vulnerability to treasury income. A large portion of net profit is influenced by investment income. As seen in Q4 FY26, volatility in bond yields can lead to significant mark to market losses. Next is lead quality concerns. Despite AI improvements, some suppliers still report issues with junk leads or non serious buyers, which can lead to churn in the lower paying subscription tiers. Next is SME sensitivity. The core customer base consists of MSMEs, who are often the first to cut spending during economic downturns or inflationary periods. Next, let's look at what are the opportunities in front of the company. First point is SaaS and fintech integration. The expansion into accounting, procurement, and logistics create a sticky ecosystem that increases the average revenue per user. Next is Digital India tailwind. Continued government focus on digitalizing MSMEs and the rollout of open network for digital commerce provides a larger pool of potential digital adopters. Next point is export and international expansion. Potential to leverage the platform to connect Indian suppliers with global buyers more aggressively, moving beyond the 95% domestic revenue concentration. Next point is credit facilitation. Using transaction data to facilitate lending as a service for suppliers through the OCEN network. Now let's look at some of the threats which the company may face in its course of action. First is direct e-commerce competition. The rise of B2B vertical specialists and Amazon business poses a threat to specific high value categories. Next is regulatory changes. Changes in FDI norms for e-commerce or stricter data privacy laws in India could increase compliance costs or alter the business model. Next is search engine dependency. If Google changes its search algorithms, it could significantly impact organic traffic, forcing IndiaMart to spend more on paid marketing. Next is macroeconomic headwinds. Sustained inflation or a slowdown in the Indian manufacturing sector would directly impact the marketing budgets of small businesses. So, friends, that was a short company and stock analysis of IndiaMart Intermesh Limited. If you have found the video useful, please like, subscribe, share, comment, and support. Thank you.